All right, so today I wanted to talk about a stock that I've never actually made a video on before. I have started to dollar cost average into this company because I think it's a very good company. This is Analog Devices, ADI is the symbol. Again, it is a semiconductor company, a market cap 88.9 billion, so it is a large company. Dividend yield just under 2%, free cash flow yield 4.45%. It is a little bit above its 52-week range, the low 133, the high 200. It is right around 175 right now. So again, semiconductor company based out of Wilmington, Massachusetts. Year to date, so let's look at the price action on this company. It is up fairly nicely, I think, here. Let's check and see. About 8%, but again, if you look at the high here, it was up. It was actually about 20% up at one point. Let's get into the insights here. Analysts look like they're moderately bullish on this company. Dividend, again, the dividend I'll get into later. The growth is one of the main things that I really like about this company, one of the many things. Very good growth metrics. The financial health is actually decent. I mean, it's got a 1.8, 1.79 current ratio. That's good. They're buying back shares. The only thing that's concerning is the intangibles is a little concerning. As far as management goes, they're pretty good there as well. The profitability is the best thing about this company. Again, crazy good operating margin, net margin, gross margin, you name it. Crazy good profitability. If we look at the valuation here, again, this is very important because, again, like I've said a million times, yeah, you might have a good company, right? But again, you got to make sure you're not paying too much, because if you're paying too much for a good company, you might not get the returns that you think you're going to get, right? Because just because it's a good company doesn't mean you're going to get good returns. You have to make sure you're paying a good price, right? Price to free cash flow, the 5-year average is 24.31. It is currently below that at 22.48. Again, it is also below it, significantly below its 5-year average PE. So again, this is a good time to be buying, in my opinion. I'd like to get it a little bit cheaper, obviously, but I think it's still a good time, in my opinion. If we look at the financials here, again, very nice balance sheet. Again, other than the intangibles, that's really the only thing. But again, it has 78% assets versus 21% liabilities. Again, very good numbers there. If we look at the cash flow, this is another very important thing that I like to talk about. If we look at its cash flow, free cash flow over time, again, consistently going up. And again, last year, an all-time high by quite a bit. Again, they're buying back shares. They haven't issued a new share since 2017. Over time, they're paying down debts too, which is also good to see. So that's also very good to see. I mean, if we look at the income statement here, again, let's look at the income statement. If we look at revenue, again, consistently going up over time. I mean, they've 6x'd revenue over the last 9 years. We look at the gross profit, again, consistently going up over time. Again, those are the kind of numbers that I really like to see, right? Let's look at the metrics here. Again, if we look at the operating margin, again, it's actually almost as high as it's ever been. If we go back about 8 years here, again, 30%, 26%, 28%, 30%, 31, 23, 30, 24. So again, consistently a very, very profitable company. That's exactly what you want to see. Again, consistent, very nice profits. Again, the last thing I'll touch on here, the dividend. Again, this is just the cherry on top, in my opinion, because again, you don't want to buy a company just because of the dividend, right? It's got to have a very good business underneath, right? Because if it's got a high dividend, but the business is terrible, well, it's likely in the future that dividend's going to go down, right? And again, not only that, the share price probably will go down as well, and you will get burned, right? So again, that's something to keep in mind. So again, the current yield's just below 2%. Payout ratio just below 50%. Again, it's going up 12.3% per year. That's exactly what I want to see. Those double-digit growth rates are what you want to see, because over time you're going to have a crazy high dividend, right? Again, if we go back 10 years, it's almost a 8% yield on cost, right? 7.7%. That's how high your yield on cost would be if you'd bought this company 10 years ago, right? So that's why I like these companies that are consistently raising dividends, right? Again, because not only do you get that high dividend, but you'll get a share price, it's still going up nicely over time, right? And that's where you get that snowball effect, where you get these crazy good returns, right? So again, look at the dividend per share, again, consistently going up over time. Every single year it's going up. So that's exactly what I like to see, right? Again, that consistent growth. So anyway, that is analog devices. Again, like I say, I've started to dollar cost average, and I will continue to do that until it gets expensive, because again, a very, very good company in my opinion. So again, if you liked the video, feel free to comment. Please like, subscribe, and stay tuned for more.